Welcome everyone. Today we're diving deep into one of the most high-stakes economic showdowns of our time, the tariff war between the United States and China. Over the next 12 minutes, we'll break down exactly what tariffs are, how the battle lines were drawn, and what the cascading effects mean for global trade and everyday consumers. Whether you're an economics student or just curious about how international policies can affect your grocery prices at the local market, this story has something for you. Let's set the stage. First, a quick primer on tariffs. Think of tariffs as taxes imposed on imported goods. Governments use them as leverage in trade negotiations, aiming to protect domestic industries while trying to correct imbalances in trade. In the case of the US and China, the idea was to pressure the other side into a fairer trading relationship. Our story begins in 2018 when President Trump initiated tariffs on Chinese imports, citing unfair trade practices and intellectual property theft. China retaliated, marking the start of a tit-for-tat tariff exchange. A Phase 1 deal was signed in 2020, but tensions simmered beneath the surface. But the story really took off when the US government, under President Trump, began imposing tariffs on a wide range of imports to address these trade deficits. These measures weren't just about economics, they signaled a shift in how global trade might be conducted in the coming years. By taxing imports, both sides hoped to push the other into negotiations, but as we'll see, things escalated quickly. Let's talk specifics. Initially, the Trump administration introduced a baseline 10% tariff on many imports. The idea was simple: impose a small cost on imported goods to encourage American consumers and companies to buy domestic products. But things took a dramatic turn once tariffs targeting China came into play. Soon, a tariff on Chinese products ramped up to a staggering 145%, a steep move intended to undercut China's trade surplus and force them to negotiate. Notably, while the U.S. paused tariff hikes on nearly 60 other countries for 90 days, China was not afforded that pause. China's reaction was swift and resolute. In response to these high U.S. duties, Beijing raised tariffs on American goods starting at around 84% and then leaping to approximately 125%. In other words, both sides escalated quickly. And it wasn't just about money, it was about sending a clear political message. Now, what was the thinking behind these moves? President Trump often described his tariff decisions as driven by instinct. He suggested that there's a fine balance. I don't want to go higher because at a certain point, you make it where people don't buy. In other words, excessive tariffs can hurt American consumers by raising prices. Yet the goal was to protect jobs and industries in the U.S. by making imports less attractive. Trump's rhetoric was both impulsive and calculated, a tough-talk approach intended to create pressure. He even claimed that by imposing such significant tariffs, America could secure fairer deals not just with China, but with other trading partners as well. However, critics argued that this tariff by instinct strategy risked creating unpredictable market turbulence and might lead to long-term economic fallout. Across the Pacific, China was not sitting idly by. Chinese officials made it clear that they were not afraid of a trade war. In response, Beijing struck back by raising its counter-tariffs on U.S. goods to around 125%. The Chinese stance was clear. If the U.S. imposes punitive measures, China too will respond strongly. This tit-for-tat wasn't just a numbers game, it was a display of resolve. Chinese business owners, however, felt the pinch as these tariffs drove up the costs of American products. In bustling markets from Beijing's urban centers to regional trade hubs, small business owners recounted how imported U.S. goods became increasingly expensive. Some shopkeepers even began seeking products from Europe or turning to domestic alternatives to avoid the steep costs. In doing so, China wasn't just defending its position. It was also adapting to the new trading reality imposed by the tariff war. The impact of this escalating tariff war rippled far beyond the borders of China and the United States. Global trade markets reacted with volatility. International news outlets reported market swings that rivaled some of the most turbulent days since the COVID-19 pandemic. Major financial indices, including the S&P 500, faced dramatic leaps and drops as investors braced for further instability. The World Trade Organization even warned that the trade battle could lead to a decoupling of these two economic giants, with bilateral trade potentially dropping by as much as 80% if the standoff continued unabated. Imagine a world where commerce between China and the United States, the very foundation of the global supply chain, begins to unravel. Economists caution that such a split could force the global trading system into separate blocks, significantly hampering global growth and sending shockwaves through industries from tech and automotive to everyday consumer goods. While both nations traded tariff blows, negotiations and diplomatic talks were simultaneously underway. Notably, the Trump administration engaged in talks with several nations, Japan, Mexico, Italy, and others, to negotiate tariff exemptions or delays. For instance, Japan sent high-level trade envoys to Washington for discussions that touched on tariff fairness and military support costs. The United States maintained a flat 10% tariff on many nations while holding out for more favorable terms. Yet when it came to China, no such pause was allowed. The message was unambiguous. Beijing was expected to come to the negotiating table restlessly, but with firm terms. These diplomatic exchanges hint at a broader strategy. Beyond the U.S.-China standoff, each tariff decision was a calculated move in a larger global chess game, where trade rules and alliances are continuously being redrawn. Looking ahead, what does the future hold? Recent commentary from both sides suggests a simmering possibility of de-escalation. President Trump's hints at potentially easing tariff pressures, aiming to avoid stifling consumer demand, might signal an opening for dialogue. Yet China has so far maintained a tough posture, emphasizing equality and mutual respect as the only acceptable framework for negotiations. The dynamic remains uncertain. On one hand, high-stakes tariffs serve as a bargaining chip meant to bring the other side into a fairer deal. On the other, they risk creating long-lasting disruptions. Reduced bilateral trade may force entire industries to reconfigure their supply chains, while consumers, whether buying American-made or Chinese-imported products, could be stuck paying higher prices for years to come. Some experts even predict that a prolonged trade war could contribute to a global recession, with slowed economic growth and a restructuring of international alliances. To wrap things up, the U.S.-China tariff war is more than just a back and forth over numbers. It's an evolving saga that touches on national pride, economic strategy, and the very fabric of global trade. While tariffs are a tool designed to protect domestic industries and correct trade imbalances, their ripple effects extend to small businesses on both sides of the conflict and even the stability of the world economy as a whole. Whether this aggressive tariff tango ends in a comprehensive trade deal or in a prolonged stalemate remains to be seen. What is clear, however, is that both nations, and indeed the entire world, are watching closely, aware that the decisions made in boardrooms and on trading floors today will shape the economic landscape for generations. Thank you for joining this deep dive. Stay tuned as we continue to track new developments in this complex and high-stakes economic drama.